Thanks everybody for joining us today. I'm Megan Coelho. I'm the president of Advice Chaser. And before we introduce our guests and get started, I'm going to do a little bit of legal housekeeping here. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. So, Ed, if you could go ahead and advance to the next slide. I'll tell them all about our webinar today. We're thrilled to bring you this educational presentation. Just so you know, attendees are muted, but we encourage you to ask questions using the chat box down at the bottom of your screen there. The presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, feel free to leave your phone number and email address as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So I'd like to introduce you today's moderator, who's Mark Seither. Mark, give us a little wave there. That's Mark. He is a partner and a wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial mind helped him to thrive as a financial advisor. As Mark honed his skills as an advisor and a planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders, a retired Navy and current Southwest pilot, to build Kingsview Partners. Together, they assist individuals with wealth management and taxes, specializing in the specific needs of pilots. So then we have our presenter today is Ed Cotney. Give us a wave, Ed. Ed is the founder and principal at Olympus Tax, Business and Insurance Solutions Incorporated. He's also the author of Tax Secrets Made Simple. He hails from Alabama, earned degrees in physiology and aviation management, and served active duty in the U.S. Air Force for 20 years before retiring in 1998 in Northern California. Ed graduated from the prestigious professional mentoring program in Franklin, Indiana, where he became a family wealth counselor in 2000. Lauded for making the complex simple to understand, Ed is well known for providing continuing education classes to professional advisors from basic to sophisticated estate planning techniques, business formations, mergers, private placement, research and development tax credits, domestic asset protection trusts, domestic international sales corporations, business succession planning, and multi-generational business planning. So from here, I'll let you guys take it.
Well, hello, Megan, and thank you for getting us all teed up for the project we're going to cover today. And for those of you who are flying everybody around the country, I just want to say I'm thankful and grateful for you moving us from point A to point B during this pandemic this last year. It has definitely been an interesting time as we move forward with things. Josh and Mark asked me to share with you some insights and thoughts in respect to IRAs and 401ks and what people aren't talking about. We as a society are told, hey, you work, create an IRA 401k, shovel money into it, it grows compound tax deferred, and then you've got a retirement plan superior to Social Security and other types of programs. And so I want to talk about what we're not talking about. I want to talk about things we need to start asking questions about. I want to help you understand what happens when nothing has been put in place to plan for your IRA or 401k. One, how to be tax efficient using that money for the rest of your life when you do retire. And two, how do we transfer this asset to our heirs if our goal is to move money to our children or nieces, nephews, etc.? How do we transfer the hottest taxable asset we own at death on our balance sheet to our heirs with the least amount of tax issues and with the highest degree of asset protection? That's the two things that we really need to have discussions about, because we just don't have a lot of discussions on it. And then on top of all of these issues that were already present in 2020, we saw a ton of tax issues happen and change. And one of them being Code Section 590B, which has to do with IRAs and 401ks. And so we're still waiting on language. So a lot of people are scratching their heads on what to do with inherited IRAs and things like that. But the most common mistakes that families struggle with in respect to not addressing this issue, they miss annual tax planning opportunities to start solving these tax problems long before they turn 72. You can start solving the tax issues with your IRA literally about 57, 58, absolutely by the time you're 60. You can start looking at tools and strategies to capture tax benefits, to reposition monies out of your IRA long before you're required to take money out of these things. Another big issue is the estate tax planning mistakes. You know, last year we saw 3 tax proposals to redo the tax plan, Von Holleran and Saunders, and also Biden's tax plan. And all of 3 of those plans had pretty significant tax issues in respect to the death tax planning side of the estate. And it's painful. And I'm going to walk you through what it could have looked like and what we probably need to be preparing for, because I don't think the tax issues in respect to the future are going to go away. We have to do something from a taxation perspective. And I'll share with you my opinion on why I think that this thing fits. We also forget that when we do retire and have to start taking out their RMDs, there is that 50% penalty. So if you're required to take out $50,000, there's going to be a big tax penalty if you don't take it out. And I also sometimes will have a child that's a special needs beneficiary. I want to touch on a couple of important issues there in respect to IRAs and special needs children and asset protection, and what we can do in respect to using our IRAs for deductible medical expenses when we get old and go into a care home, you know, that type of thing. And some of these issues you may apply to your parents in respect to them being older with IRAs and 401ks. So this may be more than just for you. It could be for you and your parents. So old rules, new rules. A lot of things changed in 2020. The big one that most people are aware of, the RMD went from 70.5 to 72. So that's kind of cool. It helps us build more money in the IRA 401k model. And then the Secure Act did make it so that if you're charitably inclined, they kept the 70.5 age requirement in there, that if you wanted to make a contribution direct from your IRA to a charity at 70.5, you could do that up to $100,000 a year. And if you are 70.5 making charitable contributions, I beg of you, make certain you talk to a qualified tax professional about doing this, because it is overwhelmingly the smartest tax play you can do if you're making charitable gifts after 70.5 and you have an IRA. And of course, big changes for the inherited IRA rules, where it used to be kids get monies for a long time, over 5 years, or take it out at once. Now there's a big rule that says your IRA beneficiaries' children have to take all the money out within 10 years. So let's kind of look at the old rules real quick. In the old days, 2019, we have these IRAs, we pass away, and then our non-spouse beneficiaries, they can take it out all at once. And the issue there is that if your child is making $150,000 a year and they inherit a $300,000 IRA and they take all $300,000 out that year, that means they're going to have a $450,000 adjusted gross income, which means the money that they earned because they took out that IRA puts them in a higher tax bracket, which means the money they earn is actually less money in their pocket. So a lot of times our kids don't give thought to these issues. And when we look at when we die, our children within about a year or two overwhelmingly will raid the entire inherited IRA totally ignorant of the tax consequences associated with it. So we do need to kind of prepare our kids in a way to help them understand, hey, I worked hard for this IRA, you just inherited it. Please don't give more of it to the IRS than we absolutely have to. And then we also had these rules about if you don't take it all at once, you could take it out over 5 years. And then there was another rule that said you could elect stretch option. And so stretch option was a simple model that said, mom and dad passed away. Here's a $300,000 IRA, and I am 49 years old, and I will elect an RMD. And so unlike the IRA you created where you don't take money out as a requirement at 72, an inherited IRA into the old rules, if the child elected stretch option, they would have to start RMDs at whatever age they were, 18, 49, whatever. Different set of rules for the inherited IRA. Now that inherited stretch option was the most tax efficient way to go, but they got rid of it. Stretch options no longer allowed. And so we end up with an all at once type scenario as one model, which is just like the old model was. And the new model is mom and dad pass away. We have an inherited IRA. The kids have to take the money out within 10 years. There is no X amount they must take out per year. It's just mom and dad died. The money moves to a new account because it's now an inherited IRA. And the kids, here you go. Here's the money. Take it whenever you want to, but you shall take all of it within 10 years. And if you don't take it all in 10 years, we've got issues, taxes, etc., that you have to pay. So when I use the term qualified assets, qualified retirement plans, I'm typically talking traditional IRAs, 401ks, certain types of annuities, bonds, pensions. I'm not talking Roth. Remember, Roth is monies that you've already paid taxes on. You funded a Roth with after-tax money, okay? The key thing with qualified assets, it's always ordinary income to you or your heirs. There are no step up in basis advantages to qualified plans. It is always tier one, ordinary income, no matter who takes the money out, with the exception if you give it to charity. Assets subject to double tax trap. We had a lot of people this last year with all these new tax proposals really just going crazy with, oh my gosh, I'm not subject to estate taxes under the current rules, but under all three of the proposed rules that we had this last year, it brought the death tax number down. And to make death tax planning real simple, each one of us has what's called a lifetime unified credit coupon that when we pass away, our assets under current law gets a step up in basis. And under current law here in 2022, if my non-qualified assets are less than $12,060,000, those assets transfer to my heirs, zero tax. Kind of a big, big cushion. Most of America does not have more than $12 million. So we're comfortable. In the proposals we had last year, one had a death tax number set up for 1 million. The other two had the death tax cap set up at 3.5 per person. Now, a lot more of America has $3.5 million. And so when we do pass away, regardless of whatever the estate tax numbers are that year that we passed, my spouse and I, the second to die if you're married, we may have a death tax 706 estate tax return that may be due. And if we do have an estate that is larger than whatever that number is, 3.5, 6.2, 12.02, whatever the magic number is that year you die, if your estate is larger than that lifetime unified credit, you could have an estate tax exposure. And under current law, it's 40% on every dollar past $12,060,000. Here's the double tax trap. If you die in a year that your estate is subject to estate taxes, let's say the number's 5 million. If you have an IRA larger than that as part of your overall estate, you could end up with your IRA subject to both income taxes, because remember, no matter who inherits that IRA, there's an income tax bill. And if your estate is larger than the lifetime unified credit, we have to include it on the 706. So we have double taxes right there. And I'm only using the double tax scenario because I'm going to assume that you and your kids live in a zero tax state like Texas. If your children live in a state like California, it's a triple tax. We have California tax to pay on that thing. So I don't want to get too deep, but the point that I'm trying to share with you is, like most of America, most advisors, CPAs, tax attorneys, financial planners, bankers, most advisors have not been sharpening their pencil and talking to their clients about what if the estate tax number, instead of being $12 million, drops down to 3.5 or 5 million. So we haven't had a lot of people talking about these technical issues. And of course, we start getting really deep in the weeds here, talking about planning opportunities and stuff like that. But I want to kind of focus on something that's real simple that we have to understand. If I'm subject to estate taxes, my IRA goes to the kids under Code Section 691C. There is a little bit of a credit that my child's CPA can use because mom and dad paid estate taxes first, and then we have income taxes on the IRA. If their CPA is sharp enough to understand 691C, we can claim a deduction. If their CPA is not sharp enough to understand, yes, mom and dad had a big estate, yes, mom and dad had IRD assets like an IRA or 401k, the kids end up accidentally paying another 18%. My point is, IRAs and 401ks are still the most complex, misunderstood wealth transfer asset we have in the country that the bulk of the nation does not understand. And this is why it's great that Mark and Josh are like, Ed, we got a lot of pilot buddies. We want you to help us help them understand what are some of the things that they can be doing to get prepared to control this event so that more of their hard-earned money goes to their family and less goes to the IRS charity. Here is the graph that really puts things in perspective in respect to, do I have estate taxes, et cetera. On the far left-hand side, if we have a 40% tax, as far as the tax code, $1 million IRA, the kids just pay $400,000 in taxes, they get to keep $600,000. In the middle, if I have a taxable estate, the estate is larger than whatever the lifetime unified credit is, and then there's $1 million IRA as part of that calculation, we have an estate tax calculation of 40%, and then what's left over goes to the kids as ordinary income. And because the kids had a sharp enough CPA that knew to claim the 691C deduction, and by the way, I did a survey on almost 100 CPAs last year, asking them to explain 691C to me, 1 out of 100 CPAs knew where to claim this deduction on the 1040 for the children. 1. So in this case, we had the one CPA that knew what to do, and their tax bill floated in. Looky there, the kids got to take home nearly $380,000 of that $1 million IRA. And then for the other 99 CPAs, where there was an estate tax issue that did not know there was a 691C, the kids got to take home nearly $200,000 of the $1 million IRA. Without question, whether you're subject to estate taxes or not, this asset requires the most planning of any other asset you own if one of your objectives is to transfer the value of this asset to the kids with the least amount of tax. This is what we're not talking about. And this is what we need to start having frank discussions on and being prepared for, because we have lots of politicians run around the country who have been quoted multiple times saying all that money in those IRAs and 401k belongs to us. That is scary. So when we look at the estate plan, how do we make certain we do the most good with these IRAs? One mistake that I see all the time is the IRA beneficiary form or the 401k form will say that upon my death, it goes to my spouse. After my spouse, it goes to my trust. It is very important that you talk to your CPA or your tax attorney about, does that make economic sense? Because in most cases, if the trust does not have the right provision in there, it's called a conduit provision, just use that term. Does my revocable trust have a conduit provision? Because if an IRD asset like an IRA or 401k were to hit your revocable trust after you've passed away, it could be subject to the highest tax rate in the country. The next thing we have are beneficiary forms. It amazes me at how many times the beneficiary forms are blank, filled out wrong, or have the wrong people's names on it. Every time you do a change to your IRA 401k, custodial management, financial planner, you need to look at those forms. And I would beg of you, about every 3 years, check on those forms to make certain they are what you want them to be. And then we have the estate taxes eat up your IRA. I kind of touched on that a while ago. We definitely want to be able to talk about how to do that. And what Mark, Josh, and I are going to share with you today is a technique to help you control that. And like I mentioned earlier, over 95% of our heirs, our children, that when we pass away, they will consume the monies in our IRAs and 401ks in less than 2 years. A lot of people, when the IRS came out with that 10-year rule last year, we got rid of all the old stretch option stuff. A ton of people came out, oh, this is not right. It should be more than 10 years. Statistically, the kids are taking the money out in 2 years. And my thoughts was, why 10? Why not just change it to 5? It's not going to matter. The kids are taking the money out. So here's something we need to understand that statistically supports this concept. Most of us put money in an IRA. We get to our required minimal distribution age. We take out the RMD only. We have a financial planner that does a great job. And if we only take out the RMD each year, we typically find that 90% of the people who make it to age 90 will still have 90% of their IRA still intact. In fact, until the client starts taking money out at about 84, 85 is when we see the return of the IRA with the RMD calculation the same. So until I get to be about 84, 85, my IRA is probably still growing at a rate greater than my RMD. So your IRA is not something that's going to go away. The after-death assumptions, oh, my kids will leave the money with my financial planner that I've known for, no, they won't. My parents believe, most parents believe that their qualified plans get a step up in basis. No, they don't. It's ordinary income. And most people believe that their inherited plans are protected by ERISA and state law. Now remember, 401ks are ERISA protected. IRAs, traditional IRAs, are governed under state law. Here's the deal. And I'm going to share with you why this has changed so significantly. Inherited plans like IRAs and 401ks are no longer considered inherited IRAs, thanks to a 2014 Supreme Court ruling. The court now considers inherited IRAs untaxed property settlements. That's a scary word to hear that the court is using when we hear the word untaxed at the courthouse. I'll walk you through with this issue. When we start talking about charitable receptivity, and before you turn off the presentation today, it is amazing how many people in this nation are charitably inclined who have no clue on how to use charitable tax planning techniques to make money for themselves and their children. Poor people don't understand charitable tax planning models. So if you ever hear an advisor say, let's look at a charitable tax planning strategy to help us solve a problem, you're probably talking to a higher end advisor that understands that charitable tax planning tools are far superior to non-charitable tax planning strategies. And there's a way to put these things together. I'm going to demonstrate one model of those things for you today. So the qualified charitable distribution, that rule stayed in place, age 70.5, I can give up to a maximum of $100,000 per year from my IRA estate to charity. I don't get a tax deduction, but more importantly, that money does not hit my tax return. So I don't have to pay taxes on it. And I have countless people call me every year, Ed, I'm 76 years old. I don't want to take the RMD. Is there a way to get around it? Because I don't need the money. I'm good on everything else. Okay, well, if you're giving money to your church or college or something, give money from your IRA straight to the university. It's the tax efficient thing to do. We do have higher standard deductible rates. For married, we're 25, almost 26, and single, almost 13. One thing that I find that just blows my mind, when I ask people to show me what their tax deductions were, they'll go, we have all these tax deductions because we gave this much to the church. We have mortgage interest deductions. And overwhelmingly, people will not have a number larger than the standard deductions. Remember under TCJA that when it got passed back in 2017, it nearly doubled the standard deduction. And for about 70% of the nation, the standard deduction is the smart play for them. And so even though they have an IRA and they're 74 years old, they gave $2,000 cash to their church. In their mind, they thought they got a tax deduction. But the reality is, when you look at Schedule A and the rest of their tax return, they had to claim the standard deduction because it was larger than Schedule A, which is where we have medical costs and charitable gifts and all that stuff. So once again, if you're over 70.5 and you're making charitable gifts to a favorite nonprofit 501c public charity, it behooves you to ask the question, should I give money from my IRA straight to charity so that I can pay less tax? It's just something we have to consider. So the tax mistakes that I see happen at death all the time, the assets on the left side of your screen, house, cash, land, stocks, cars, life insurance, overwhelmingly, if we're not subject to estate taxes, those assets get a step up in basis, transfer to our children, zero tax. IRAs and 401ks never transfer, zero tax. So I want to give you a case study, and this is, names have been changed to protect the people, but this is an actual case study with Tim and Susan Miller. They want to transfer their estate to the kids, free from tax, free from lawsuits, free from predators. I think all of us want that. I mean, these are pretty simple objectives. Susan had come in to talk about her husband had died a couple of years earlier. They have 4 kids. They have a house worth $400,000, cash and stock $400,000, and an IRA of $800,000. Now, I know most of you on this call are looking at going, how can you have a home worth $400,000? That's like a down payment anymore in New York and Florida, New Jersey, and California. How can you have only $400,000 in investment assets in only an $800,000 IRA? My point is this. I'm going to show you how we turn this small estate into something significantly beneficial to the family with the least amount of tax. All right, prior planning, that was great to see. They had a will and a trust. Are you kidding me? For those of us driving cans all over the country with wings, we need to have a wing. We need to have a will and a trust. Investment trust, everything titled properly. Your house titled to your trust. Your investment accounts titled to your trust. Remember, your IRA 401k is never titled to your trust. It belongs to you in your name. It's a retirement plan. So assets are titled. The home is titled to the trust. The beneficiary forms properly filled out to people that are alive and well and people that I know and love. And the distribution is equal and outright. This one here gets a little interesting because sometimes the distribution being equal and outright to all the kids may not make sense. But in Susan's case, her and Tim love their children equally, so they wanted each child to have a fair, equal share. And I'm going to show you why this may not be the best choice all the time. All right, so here's Mike, one of the kids, successful doctor, killing it, making tons of money. You have to ask the question, if Mike's net worth is $25 million today, does he need to inherit another dollar? Well, if you do the math real quick, Mike, as a married person, they have a $24 million lifetime unified credit. So if Mike and his wife die today, they have an estate tax issue because they're over the $24,120,000 married couple number. So we give Mike another $400,000 in assets. That just means we have another $400,000 that's going to get a 40% haircut. Okay, but we still love Mike equally. Their daughter Mary, not in the greatest marriage. In fact, at Tim's funeral, somebody overheard her husband talking about, as soon as mom kicks the bucket, we're going to go buy a new truck and a bass boat. Now, there's nothing wrong with a new truck and a bass boat. I mean, I love trucks and bass boats, but that may not be the best marriage. And it kind of gives you the scenario of, wow, is Mary really in a good spot? Then they've got a son, Ed. He's in a rocky third marriage, but he's good with money. And then Dan, he can't manage money very well, currently divorced, looking for work. I think a lot of us have a relative like Dan. Let's look at the tax issues when Susan dies. The house under current law, step up in basis, wealth transfer, no problem. Cash and stock, step up in basis, wealth transfer, no problem. IRA, rut-row. The IRA is a taxable asset. So let's talk about how to solve these issues. We have a $1.6 million estate, equal division, 4 kids, $400,000 per child. We divide the assets. Half the assets got to step up in basis, the house, the cash, the stock. The other half is an IRA. So each kid gets $200,000 of each bucket, whether it's tax smart or tax bad. When we look at the distribution here, is this what mom and dad wanted? Yes, it is equal. It is outright. And under the new rules, the kids would have 10 years to consume the $200,000 IRA that each child has. I don't know if this is really a good scenario. Let's talk through the issues here. One, are we focusing on the wrong issue? And the answer is yes. And I think here in a minute, when you start seeing all this come together, it's more than just who gets what when. We need to start looking at when the rules changed in 2014, why from an estate planning perspective, we need to treat these IRAs and 401ks with a lot more consideration. Clark versus Ramaker Supreme Court decision. Mom died in 2001, excuse me, Mrs. Heffron. She had a house, she had an IRA, and she had about 400,000 cash. So the house was sold, the cash transferred to the sole daughter, Heidi, and the $450,000 IRA, Heidi elected in 2001 this old stretch option rule. Smart play, good money, good job. Things went well, changed their lifestyle a little bit. They were busy computer programmers, her and her husband. And then in 2007, things got kind of bad, really bad. And then by the time 2010 got here, their CPA recommended that Heidi should file Chapter 7 bankruptcy. And so they did. And so the bankruptcy hearing occurred and everything was approved. But the creditor's like, not so fast. She has this $400,000 IRA that she inherited from her mom. Why can't that IRA pay her bill to me, her debt? So they go to the appeals court. Heidi lost. We finally, for the first time in U.S. tax history, had a great case go to the Supreme Court for the question to be asked. Are inherited IRAs still protected under state law, just like it was for mom? In other words, is it protected from judgment creditors and bankruptcies? And in a unanimous 9-0 ruling in 2014, the Supreme Court said no. Inherited IRAs are not protected, which means if there's a bankruptcy judgment, the inherited IRA is attachable. So what that meant here in Heidi's case is that the nest egg that she thought she was going to count on using the stretch option rule to give her a tax smart income stream for life, because of a bankruptcy, she now has to let the IRA custodian pay the judgment. And then the sad thing is, the IRA custodian is going to also do his job. In 2015, he's made the distribution, the creditors solved, and on January 1st, he prepares a 1099-R. I mean, the IRA did have a distribution, and he sends the 1099-R to Heidi to pay the taxes on a $300 and something thousand judgment payment. If you remember, this thing started out as a bankruptcy matter. And Heidi just lost a chunk of that IRA, and she has to pay the taxes on it. This was an eye-opening, landmark, big-time court case that most of the country just went, who cares? I beg of you, this is one of the most important landmark decisions we have in IRA planning models that we have in the nation that we need to pay attention to. And overwhelmingly, nobody wants to talk about this. So let's talk about how we can solve this issue, and we as the consumer taxpayer can help our advisors move forward. So that Supreme Court decision was a landmark decision in 2014. It did address the issue. Is this an asset protected item? And the two things that the Supremes focused on here was, why does this IRA lose this level of asset protection? I mean, for Heidi's mom, Ms. Heffron, she had a degree of asset protection from judgment creditors, et cetera, because it was her retirement plan. But the two things the Supremes focused on, they asked the question, did the daughter Heidi create the IRA for her mom and dad? Well, no, mom and dad created those IRAs. Did the daughter Heidi ever make a contribution into mom and dad's IRAs? And again, the answer was no. Now, there were some other technical things there as well, but those two biggies become kind of obvious. The daughter Heidi had no involvement with mom and dad's retirement plan whatsoever. And then there's questions of, even if Heidi was involved with making contributions to mom to put into the retirement plan or dad, would that have even passed muster for the Supreme Court to go, there's a degree of asset protection here, and most people are saying no. So the ruling is inherited IRAs are subject to judgment. And then there was an Eighth Circuit ruling in the 2018 with divorces, bankruptcies, et cetera, that also relied on this ruling as well. My point being, inherited IRAs are in play for bankruptcy judgments. So what can we do as the consumers, the people who own these IRAs, better understand how to protect them? So while mom and dad are alive, you have a degree of asset protection on your on your retirement plans, 401ks, IRAs, et cetera. But when we die, under the current rules, we have 10 years where there's a period of risk. If the kids are in some form of bankruptcy issue, et cetera, there's that risk that the kid could lose some money and have to pay the tax. And then, of course, at the end of 10 years, we have to take the money out. At any point, money comes out as a 1099-R taxable reporting event for the child. So here's what we suggested for Susan. She liked the idea of the old concept. She loved the stretch option rule because she loved the fact that kids could get money from this inherited retirement plan for many, many years. So she don't like the 10-year rule. She wants the IRA to be safe from her children's creditors. Now let's think about it. Of her 4 children, which one is a walking lawsuit? Well, the Dr. Mike, he's a walking lawsuit. Mary, the sister, divorce, potentially bankruptcy, there's another issue. Ed, who's good with money on his 3rd divorce, well, there's a walking lawsuit. And then Dan, who can't keep a job, who's always in trouble, multiple divorces. All 4 of her children have the risk of being at the courthouse for bankruptcy. When you stop and think about your kids real quick, what type of jobs do they have? What's their marital situation? We all want our kids to be healthy, happy, and strive and move forward, but sometimes bad things happen to good kids. We want to protect that for Susan. We want to transfer the IRA with the least amount of tax. Wow, what a surprise. I've never heard that point before. She'd like to give her kids an income stream from the grave. The reason this was important to Susan is she knows her children are in risky scenarios. She wants to make certain, particularly her son, Dan, the one who's always kind of in trouble, wants to make certain that he does not become a liability to her other 3 children being on their doorstep asking for money. She loves the concept of giving particularly him an income stream and then Mary. She's worried about Mary, her daughter. So how do we do this? And if there's a way to leave any money to her church, it'd be great. So for the next 20 years after you die, give the kids a check from the grave. We like that. Help them pay less tax on the IRA. No kidding, who wouldn't? Give the IRA away twice. Yeah, I'm going to show you how to do that today. And then give your favorite church or charity a big fat gift instead of the IRS. You do need to realize the IRS is a not-for-profit organization. It's just they're a mandatory donation organization company. Okay. So let's look at the IRA. The estate was 1.6 million. We had $800,000 of house, cash, stocks, etc., transferred to the children outright for equal, no tax. The IRA, we're going to have it go into what's called a charitable remainder trust. Again, don't turn your hearing aids off because you just heard the word charitable. I'm going to show you how this makes money. So we have the attorney set up an IRA while you're breathing today, alive. It's just a bucket sitting here waiting for you to die. We changed the IRA beneficiary form where part or all of the IRA, I recommend all for maximum tax efficiency, the $800,000 IRA or whatever amount it is when Susan dies, goes 0 tax into the charitable remainder trust. Remember, the charitable trust is a tax-exempt, irrevocable trust. Since it's an irrevocable trust, it also has a degree of asset protection. So once again, tax efficiency going in, asset protection, 2 big issues for all 4 of her children. We have the money managed by a professional money manager. We have this trust set up for 20 years because it's testamentary. 20 years is the max we can go. And so basically, if we have modest return on investment, we pay out 5.5% a year, $42,000 divided by 4. Each kid's going to get about, $11,000, $12,000 a year for the next 20 years. So as we have $11,000, $12,000 per child come out of this plan, what's the taxes on $11,000? Well, for Dr. Mike, he's already in max tax bracket, so there's no income tax relief for him at all. But for all 3 of the other children, We have a tax efficiency model in play here, don't we? And we all don't have a doctor as a child making, tons of money and worth $25 million. Most of the nation does not. So most of the nation, this is a huge tax play. It's a huge asset protection play. So just with modest investment, modest distributions, this IRA is going to transfer $896,000 over the next 20 years to these 4 children combined, with greater tax efficiency and asset protection than if we just leave it in the current tax setup. We win. Yay. And at the end of 20 years, now that this charitable trust has given out a pile of money to the kids with more tax efficiency and asset protection, whatever is left in that charitable trust goes to Susan's church. As we displayed the plan to Susan, tears were literally coming down her eyes as we showed her how to create a model that solves all of her pains, all of her concerns, all of her worries about her 4 children, even though this is a modest estate. She's sitting here looking at nearly $900,000 going to her church when this plan is done. She is crying her eyes out. In fact, we were all crying our eyes out with her. It was just a beautiful day. It's one of the most memorable days in my life to see this happen. And her words were, "I wish Tim was here to see this." We just took the worst asset you have on your balance sheet at death. We just took the worst asset you have on your balance sheet at death. It's a great asset as long as you're breathing. Just don't stop breathing. But the minute you stop breathing, absent a proactive plan like this, that money's in play for bankruptcy, max tax, etc. So the $800,000 goes to the testamentary charitable trust. The charitable trust does its job for 20 years. At the end of 20 years, what's left over goes to 1 or more 501c3 charities that Susan has chosen the money to go to. And Susan can change her mind at any point before she dies on who gets that money. Again, I just use the word charitable remainder trust. And most of the nation, when they hear an advisor say charitable something, 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 their hearing aids turn off, their brains turn off, and they go, "Oh my gosh, I'm already giving enough money to charity and it doesn't work." You need to turn your hearing aids up and open your mind. This is a power play. It works well. So I call this the give it away twice plan. We do have to have an attorney draft up the trust for you, preferably an attorney where you live as your residence, do this for you. Identify some beneficiaries and, who's going to get the money, kids, grandkids, nieces, nephews, whatever. What charities do you want to be in there? Payout rate needs to be between 5 and 6%. Susan can have the money go from the trust either monthly or quarterly or semi-annually. It doesn't matter. Susan can pick. Most people will choose quarterly, is what we see the most used. Susan retains the right until the day she dies to change the beneficiary form. So let's make certain we got this understood. She has the charitable trust set up. It's unfunded. It's just an empty bucket waiting to be funded. It gets funded if Susan's IRA beneficiary form says, "Upon my death, this IRA goes to my charitable trust." So until Susan dies, she still has full control of her IRA. Nothing on her IRA has changed. It is an IRA. Let it go. Let it do what it's supposed to do. Take the R&Ds like she's supposed to. Take out more money if she wants to. Use all the money if she wants to. But if on the date of her death, there's a pile of money still sitting in her IRA, and if the beneficiary form says, "Upon my death, it goes to my charitable trust," this is what we're trying to create, the rescue strategy to make that happen. So she retains full control of her IRA. Nothing changes. It's just what happens when she passes away. So the IRA to CRUT beneficiaries, we now have a degree of asset protection versus no protection under the 10-year rule. The CRUT is outside of everyone's taxable estate. In Mike's case, the only one of her 4 children who is currently subject to estate taxes under the most generous estate tax code we have ever had in the history of taxation in this country, it's not a part of his taxable estate. He's not going to get a 40% haircut on the money that's in the CRUT. The CRUT does give out up to about 20 years of income to the kids. Charity gets a big fat gift. The IRS literally gets less. 3 of the kids will pay less tax over the next 20 years using this model. Susan has peace of mind knowing that her children, particularly Mary and Dan, will have peace of mind knowing they're taken care of, and that every time there's a deposit into their account, it's just an electronic deposit. Hopefully the kids are going to remember him and her. And she's pleased that the IRA will never be subject to one of their creditors because of a bankruptcy, etc. You know, bankruptcy is just one of those things that happens. It could be because of lawsuits, divorces, medical. Bankruptcies happen. And we hope they never happen to our kids. But one thing's for certain, this is the one asset that we don't want the kids to have in play if they're in a bankruptcy. So better creditor protected, better for Mike, better for Mary. By the way, Ed's wife filed for divorce today, better protected for him. And of course, Dan, we're truly just trying to protect him from himself. He's just not good with money. You give Dan $3,000, it will be gone tomorrow. So it just happens that way sometimes. Again, Susan retains full control and use of her IRA. While she's alive, nothing has changed. She can change the beneficiary form every day. There's no cost. She can sleep comfortably every night knowing the kids have a safety net. The church gets a big fat gift, and Tim would be proud of her. So I want to use $1 million IRA at a second death comparison to show you financially how these stack against one another. If I have one child and I leave $1 million in an IRA to my son, okay, and if my son, after my death, decides to take the $1 million out here in the great state of California, he will pay not less than $450,000 in state and federal taxes on that withdrawal. This is assuming my son made no money. So he goes home with $550,000 of after-tax money after $1 million IRA is eaten up by taxation. Under the 10-year rule, my son had better stay out of the courthouse. If for whatever reason, he lets the $1 million stay in the IRA under the 10-year rule, and if during this 10-year period he ends up at the courthouse, if he has a judgment and he loses that $1 million, he once again could end up where he loses the $1 million IRA, and then out of his pocket's got to come up with $450,000 to settle it with the IRS and the Franchise Tax Board. This is the worst case scenario. The next scenario, if you want to give your kids an income stream that's asset protected, the IRA goes to the CRUT. So the $1 million goes to the CRUT for my son. It pays out to him about $850,000. And charity gets about $850,000. And we only lose about $250,000 in tax. Without question, the issue becomes, is there anything better than the IRA to the CRUT model as far as an asset protection and tax saving strategy for the kids? If you ever see somebody that has something better than this, please let me know. I've only been doing this kind of work for 22 years. I have not found anything that brings the value and the benefits on these untaxed property settlements that when we die, these taxable assets, this is the model that does the most good. Now, before I move forward, the thing that kind of becomes important that we need to be asking about, Ed, those IRAs, clearly I've got to do some Band-Aid work to make these things pretty and better. Most people never begin the discussion with their advisors about, am I putting too much money in these things? Are there other things that I could be putting money into that will, one, create zero tax income for me, two, transfer zero tax to my kids, and three, with asset protection? We look at our IRAs and 401ks as that thing we should never touch. I beg of you, it's one of those things you need to be touching. You need to be asking questions. Hey, I've got $1.8 million in my IRA and I'm 64 years old. Should I be looking at taking some money off the table now and repositioning that and playing the tax arbitrage game on my income tax return, where I can be kind of in a lower tax bracket, move money around, create charitable income tax deductions today so that I can optimize, the word I'm looking for here is to optimize the value of these IRAs and 401ks. Most advisors can't have this discussion with you because it gets a little complicated. But I'm here to tell you, while you're 64 years old with $1.8 million or whatever in your IRAs and 401ks, start asking the question, do I really need to have that much money in my IRA and 401ks and nothing over here that could be a zero tax income stream for me? People go, Ed, there's no such thing as zero tax income. Oh, yes, there is. You just got to start asking the right questions to the right advisors. Some of the technical things, depending on what state you're in, there's some registration, taxation things that the charitable trust may have to do. There may be a state tax return. Clearly, there's a federal tax return. You do have to have the appropriate people managing and providing oversight for these charitable trusts. So it's not something that one of your kids can be in charge of necessarily. There are some rules about investing in things that are what we call prudent investors, and self-dealing rules are applicable here. So there are a few technical things, but they're not that technical. It's just, here's the charitable trust. There needs to be people in charge of managing it and taking care of it. Please send the check to my kids. It is truly that simple, but it is something that does have rules about you can't put your hand in the cookie jar, if you'll let me use that term. So as we're coming to the end of our scenario here today, Mark and Josh, I've known for many, many years, and we've worked on a lot of cases together, and they have great discussions with their clients about, hey, what is the right amount of assets? What is the income streams we want to have? What are the things that we can do better so that we can optimize our wealth and retire in style? I know in my mind, all the years that I was doing what I was doing, I was, okay, one day I'm going to retire and I'm going to have a Piper Cub or a little 172. And instead of having to run across the country at 450 miles an hour with 200 people in the back, looking forward to that day to buzzing cows and flying around bridges and getting yelled at by air traffic. But these are the things that we in the aviation community and anywhere in the country that has these large IRAs and 401ks, we need to start finding advisors that can help us talk about these things. So Mark, do we have any questions to start talking about before we start to close?
Yes, and thank you, Ed. You definitely did the bulk of the talking. I feel like I've saved my voice for today. We did have a question. Someone did ask, like, hey, is there going to be an outline of this presentation for us to go do independent research on? This webinar will be posted for rewatching, so feel free to rewatch it as much as you'd like. I did have someone ask, how early can someone start a CRUT? Is there can you be too young, too old? Is there a limit there?
Two great questions. One, in my book, Chapter 17, I've carved out Chapter 17, which is a consumer version that you can ask Mark to send you a copy of. He'll just send you Chapter 17. It's about a 5-page, very easy read. It does address the concept that we talked about today. You can also look up this Clark versus Ramaker Supreme Court ruling in 2014. I've got a copy of that. It's an easy read, about 11 pages long. And then you can also start doing research on how these testamentary charitable trusts work. You just type in TCRUT and you'll get plenty of stuff. But the concept's not new. This charitable remainder trust has only been legal since 1969. So this is not new. It's just we're not using it. That's the problem. The second question about ages. While you're alive, different set of rules, testamentary charitable trust rules, piece of cake to work with. While I'm alive, charitable remainder trust, if I'm going to create a charitable remainder trust to use while I'm alive, to put assets in, your best assets are to put in highly appreciated assets. I bought stock at Microsoft, it grew to a bunch, I put it in, I bypass the capital gain, I get a big fat tax deduction. Now, there are some rules about ages on charitable remainder trust. And so we have to do a 5%, 50%, 10% test. And to make this a simple thing to understand, when you're younger than about 50, 55, you got to be really careful funding these charitable remainder trusts to make certain you pass all the IRS tests. Now, when you're not 50, 55, I've got a case right now, young man in San Francisco, 28 years old, just exercised $3 million in stock options. He cannot do a charitable remainder trust. He's too young. He won't pass the test. But he could do a grantor's charitable lead unit trust. He could do a charitable pooled income fund. So there's about 60 different charitable tax planning strategies that are out there. The most common the most talked about is the charitable remainder unit trust, because it is the one that's easiest to understand, but it is something that doesn't bode well when you're less than 50-ish, is when you really got to get really tight with the calculations to make sure you pass all the rules. But when you're younger, there are other tools that work. And when you're older, there are other tools that work. It's just, of the 60 tools, the charitable remainder trust gets probably 90% of the attention, and the other 59 extremely effective, very powerful tools don't get talked about, because it's just another complex things that people have to learn. And I will tell you today, I've only been doing this 22 years. I'm still learning about some of these advanced tax planning strategies. Nobody knows it all. But I do know that when somebody asks me something that's weird or unusual, and I don't have a tool that I work with all the time that fixes it, I can start calling people that I know going, hey, I've got this weird, unusual case, and this is what we're trying to get as an outcome. They're charitably inclined. We want to pay less tax. We want to do great good. And it works that way. So the issue is the question. Start asking the questions. And when somebody says, no, you can't do that, get a second opinion. Most advisors that don't know how to do something, when you ask them, can I do this? The default safe answer for the advisor is, no, that's not a fit for you.
Yeah. Thank you for that. And yes, there are there are ample amount of strategies out there. So you know, if you do come and say, hey, you know, is this charitable remainder unit trust going to be good for us? You know, it may not, and we'd be happy to point you in the direction of Ed and to find one that is going to be good for you. We did have another one come in. Someone asked, hey, there was mention of a special needs trust. Does this strategy work similar to if you're funding special needs trusts?
Great. I'm glad you brought that up. The issue on a special needs trust, you need to ask the attorney that designed the special needs trust and your CPA, what are the consequences if an IRA or 401k flows into a special needs trust? What we prefer to see to be tax advantageous is to fund the special needs trust with cash, stocks, real estate, or life insurance. Those are the preferred tools to fund a special needs trust. I had a case a few years ago here in Northern California where the family had one daughter that was special needs, and they were going to leave the estate to 4 other nieces and nephews as well. The problem was they were going to leave a $2.2 million IRA to the special needs trust, and they were going to leave $2.5 million in real estate, cabins and rentals, to the 4 nieces and nephews. From a legal estate planning perspective, no problem. From a taxation perspective, it could not have been worse, because when that IRA asset transfers to the special needs trust, it gets in the 37% federal tax bracket when the first $13,000 in change hits it. It is the most onerous tax burden you can have, is when an IRD asset like an IRA 401k goes to a special needs trust. It is the most horrible tax scenario possible. The smarter tax play would have been to have the $2.2 million IRA go to the 4 nieces and nephews. This way there's some tax efficiency, because we're dividing that $2.2 million ordinary income event among more heartbeats, and then have the assets that got to step up in basis, mom and dad's house, the rental properties, etc., go to the special needs trust. We would have no tax consequences whatsoever with the right assets going to the special needs trust. Unfortunately, our attorneys don't understand all of this. A few do, but most don't. So special needs trust planning for a child, it is critical that the right assets go to the special needs trust, and you don't let the wrong assets go to the special needs trust. Did that answer your question?
Yes. And again, so for the one out there who asked it, if you need more clarification, I mean, we're happy to provide more information, be very specific to your unique scenario, and for everyone out there too. As you can see, Josh and I kind of joke with people saying like, hey, most people wake up January 1st and they go check their rate of return, from January to December, January 1st to December 31st. And if you were to pair that with their tax inefficiencies, you'd hear a whole lot less bragging when people realize, well, I made money, but I was so tax inefficient, I actually barely broke even. So These advanced strategies, I mean, there's an ample amount of them. Ed's book is amazing. He walks through quite a few of them. And any other, questions that are out there that I don't think we're, because we're coming up on time, we are happy to answer one-on-one, do follow-up calls, anything needed.
Wonderful. Thank you so much, Mark and Ed. On behalf of Advice Chaser, I'd like to thank you both and the organizations that worked with us to bring this webinar to all of you today. Thank you for attending, and you can look for an email soon with a link to a replay of the event. You're also welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offering a free initial consultation to anyone we introduce them to. You can find out more by going to advicechaser.com and clicking the link to find an advisor. Thanks again for coming, and we'll see you at another webinar soon.
Goodbye, everybody.
Thank you.